Here's an uncomfortable question nobody asks out loud. What if you did everything right? You saved diligently, read the articles, followed the advice, yet the IRS still came after you. Not because you cheated, not because you were dishonest, but because a simple procedural mistake in your Backdoor Roth IRA made everything look suspicious on paper. The Backdoor Roth is completely legal. It's a smart, legitimate strategy, but it contains 5 specific traps that thousands of responsible people fall into every single year, and the IRS knows exactly where they are. You're 32, or maybe 35. You're earning between $130,000 and $160,000 a year. After taxes, you take home roughly $95,000 to $105,000. Living expenses eat up most of it: rent, car, groceries, everything, leaving you with just $1,800 to $2,500 left over each month. You've heard about the Roth IRA, how it offers tax-free growth and tax-free withdrawals in retirement. But there's a catch. Your income exceeds the direct contribution limit, around $161,000 for singles back in 2024. So you turn to the Backdoor Roth. You contribute to a traditional IRA with after-tax dollars, then convert it to a Roth. In theory, it's simple. In practice, it has more moving parts than most people realize. The first common mistake is forgetting to file Form 8606, or filing it incorrectly. This form tracks your after-tax basis in the traditional IRA. Skip it or get it wrong, and the IRS may treat your contributions as pre-tax money. That leads to double taxation later, plus $50 penalties for each missing year. The fix is straightforward. File Form 8606 every single year you make a non-deductible contribution. No exceptions. The second mistake is ignoring the Pro-Rata rule. If you have any pre-tax money sitting in traditional IRAs from old rollovers, the IRS doesn't look at accounts separately. It treats all your traditional IRAs as one big pool. So even if you contribute $7,000 of clean after-tax money, only a small percentage of your conversion stays tax-free, and you suddenly owe taxes on the rest. The solution? Roll that old pre-tax balance into your employer's 401k first. Once it's out of the IRA pool, your backdoor conversion becomes clean and tax-efficient. Third, converting too slowly. If you leave the money sitting in the traditional IRA for weeks or even months and it earns even a small gain, that growth becomes taxable upon conversion and complicates your paperwork. The fix is easy. Convert the same day or within 1 to 2 days while the money stays in cash with zero growth. Fourth, accidentally exceeding the annual IRA contribution limit of $7,000 or $8,000 if you're 50 or older. This happens more often than you think. Maybe you contributed to a Roth earlier in the year, or your spouse coordinated poorly. Excess contributions trigger a 6% penalty per year until fixed. Always track your total contributions across all IRAs. If you go over, withdraw the excess plus earnings before the tax deadline. Fifth, treating the Backdoor Roth as a one-time event instead of an annual system. Life gets busy. People forget to contribute one year, or forget to convert, or skip the paperwork. The smart move is to turn it into a routine. Contribute in January or early February, convert immediately, verify Form 8606 at tax time, and keep a simple record of your after-tax basis. It only takes a few hours a year. The Backdoor Roth sits at the intersection of contribution rules, conversion rules, and documentation rules that don't always talk to each other clearly. People who succeed aren't necessarily smarter, they just document everything, follow a consistent schedule, and never assume that getting it right once means it's on autopilot forever. Done correctly, it delivers quiet, compounding, tax-free growth worth tens of thousands of dollars over your career. Done carelessly, it creates unnecessary tax bills and unwanted regulatory attention. The good news? The cost of doing it right is almost zero. It just requires a little consistent attention. So remember this. File Form 8606 every year. Handle the Pro-Rata rule by clearing out pre-tax IRA balances. Convert quickly, stay within the limits, and treat the whole thing as an annual disciplined process. You don't need to be an accountant, you just need to be slightly more careful than most people bother to be. If you found this calm, practical breakdown helpful, consider subscribing for more straightforward financial insights.